Okay, so continuing with some of the top rules as mentioned earlier, let's just look through the nature of protective stops. We emphasized the importance of downside protection, protection against losses. That being the case, we have to have a deep understanding of types of losses that one can incur, the types of stops that one can have in order to protect against losses. Now, let's imagine you've got a chart like this, and with the entry level, as you can see, pointed here. Well, one type of protection is the protective stop. That's the stop loss we put in initially, which tells us where we know we're wrong. In this case, it's been placed at the low point, preceding day's low, which also is a low point for several trading sessions going backwards. Makes sense. If the price were to dip below that, it strongly suggests that we were wrong in the evaluation that the market was going to continue upwards. So that's the protective stop. The trailing stop then is the stop which rises lockstep as the prices rise. We want to move that forward, ever onwards, and that of course makes sense. As you can see, we might want to take partial profits. That's a different type of stop. That's where we might have some degree of uncertainty, so forth. And you've got the profit target, which is the other type of stop there, which is the exit stop. So just in case you weren't clear on all of those, it's set out clearly for you there now. The next thing we want to go to in the top rules are money management rules. The 2% rule, which I've mentioned many times before, and I'm going to mention it again. Let's say, for example, you had a £100,000 portfolio. Yep, relatively straight. What that means is you should not lose more than 2% of that portfolio on any one trade. You should not lose more than £2,000 on any single trade. 5 times, let's say you had 5 £20,000 positions, then 10% loss on any one is the most which you can incur. Let me explain that. If you could not lose more than £2,000 on any one trade, and let's say you place positions which are £20,000 in size, then £2,000 out of 20,000 means a stock would have to drop 10% before. That's if you bought £20,000 worth of stock, it'd have to drop 10% before you lost that £2,000. And that £2,000 represents 2% of your overall £100,000 portfolio. So your individual stop loss is fairly large, 10% drop. I mean, pretty much, you're fairly sure that stock is not going your way if you do incur that. Your individual portfolio losses are not too big, 2%. Why 2%? Well, it protects your overall equity. Remember, swing trading is about protecting the downside. So that's one of the key, most important money management rules that I've stated there. I know I've rushed through it a little bit, but that's because I cover it in so many of the various CDs. But it is a very important one. On any one position, you should not lose more than 2% of your overall portfolio size, which can represent, depending on individual position sizes, fairly large percentage in any event. Okay, let's crack on to another top rule. Now this one is more qualitative than quantitative. It's got less to do with numbers and far more to do with quality, trading discipline. Sometimes you have to make very quick decisions on when to cut your losses and get out quick. The worst thing is you will see time and time again the market immediately turn after you've gone in one direction. It'll wrong foot you, you will exit, it'll then turn back in your original direction, you'll kick yourself for not having stayed in and ignored your disciplines. Don't do it. You must stick to your disciplines, and the market's job is to make you believe that you shouldn't. But you must, and you should. Learn to love small losses, take small losses, accept small losses. In swing trading, the idea is you should have a lot of small losses and a few big gains. The only way to therefore make money is to avoid having lots of big losses. The only way to do that, to love small losses. I know it sounds unimportant, it almost sounds trivial. Trust me, it is not. It is the essence of successful swing trading. It is getting out quick when things aren't going in your direction, and I guarantee you when you do this, every single time the market, let's say you're going long, the market will immediately turn as soon as you enter. It'll hit your stop loss, it'll get you knocked out of the trade, it'll then move in the direction that you originally bought in and soar away and you'll kick yourself. That may well happen. Tough. Doesn't matter. Don't neglect your disciplines. Stick with them. In the long run, you end up winning, because if you keep on taking small losses, even if you're wrong 7 times out of 10, once you get onto the bigger trades, of which there are relatively few, they make up for all those small losses and then some. If instead you let those small losses turn into big losses, all that happens is you just get a collection of big losses, and you're just not going to make it on the swing trading side. I think this is the most difficult thing for private investors to learn. It's the thing that they just don't get. It's a bit like if I told you about the greatest diet in the world, you're just not going to follow it for whatever reason, and it's the same with trading. Unfortunately, many private investors just don't follow this at all. Please do.